What's the biggest lie in the investing world? It's the idea that you need to be a genius stock picker to get rich. It's the myth that you need to find the next Amazon or time the market perfectly to build wealth. Wall Street loves this lie. The financial news lives off this lie. It makes investing seem exciting, complicated, and exclusive. But what if I told you the single best way to invest is actually boring? What if I told you that by simply not trying to be a hero, you could outperform 90% of professional money managers? Today, we're diving into the biggest debate in finance: active versus passive investing. And I'm going to show you the overwhelming evidence why the simple, boring strategy is the clear winner for almost everyone. Let's start by defining our terms. What is active investing? Active investing is the attempt to beat the market. It's the process of actively researching, selecting, and trading individual stocks, bonds, or other assets, in the hope of generating higher returns than the overall market average, like the S&P 500. This often involves trying to time the market, buying low and selling high. It's what you see in movies: the fast-paced trading floor, the intense analysis, the search for that one hidden gem. The main vehicles for active investing are buying individual stocks yourself, or paying a professional to do it for you through an actively managed mutual fund. These funds have managers who are paid handsome salaries to try and pick winning stocks. Think of active investing like trying to find a needle in a haystack. You're searching for that one specific stock that's going to outperform all the others. It's difficult, time-consuming, and requires immense skill or luck. Now, what is passive investing? Passive investing is the opposite. The goal isn't to beat the market, it's to simply match the market's performance. How do you do that? By buying the entire market, usually through a low-cost index fund, like the S&P 500 Index Fund ETFs we talked about in the last video, VOO-SPY. When you buy an index fund, you're not trying to pick winners. You're simply buying a tiny piece of all the companies in that index. The strategy is simple. Buy the index fund, hold it for the long term, and let the overall market growth do the work. Think of passive investing like buying the whole haystack. You're not searching for the needle. You're acknowledging that the haystack itself, the entire market, goes up over time, and you just want your share of that growth. So, which approach is better? The exciting hunt for the needle or the boring purchase of the haystack? The evidence is not just clear, it's overwhelming. For the vast majority of people, passive investing absolutely crushes active investing over the long term. Let's look at the proof. Exhibit A, the SPIVA reports. Standard & Poor's regularly publishes reports called SPIVA, which stands for S&P indices versus active. These reports compare the performance of actively managed funds against their benchmark index, like the S&P 500. The results are shocking, year after year. Over the last 15 years, nearly 90% of actively managed large-cap U.S. stock funds have failed to beat the S&P 500 index. Let me repeat that. 9 out of 10 professionals whose entire job is to beat the market couldn't even match it. And it's not just the U.S. The same pattern holds true globally, across different markets and asset classes. The professionals, with all their research and resources, overwhelmingly fail to beat a simple, cheap index fund. Exhibit B, Warren Buffett's famous bet. We mentioned this in the S&P 500 video, but it's worth repeating because it's so powerful. In 2007, Warren Buffett made $1 million bet with a group of hedge fund managers. He wagered that a simple, low-cost S&P 500 index fund would outperform their hand-picked portfolio of hedge funds over 10 years. The hedge fund guys were supposed to be the smartest minds on Wall Street, using complex strategies to generate massive returns. What happened? After 10 years, the S&P 500 index fund had returned an average of 7.1% per year. The basket of expertly chosen hedge funds returned an average of only 2.2% per year. It wasn't even close. Buffett won the bet easily. His point was undeniable. The fees and complexity of active management destroy returns. Simply buying and holding the market is superior. Which brings us to Exhibit C, the number one killer: fees. Actively managed funds are expensive. You're paying for the manager's salary, the research team, the trading costs. These fees often amount to 1% or even 2% of your investment balance every single year. A passive index fund, on the other hand, has incredibly low fees, often 0.03% or 0.04%. That 1% difference might sound small, but over decades, it's devastating due to the negative compounding effect we talked about. A 1% annual fee can eat up nearly 1/3 of your potential returns over your lifetime. Think about that. You take all the risk, and the active manager takes a huge chunk of your profits, even when they underperform the market. Passive investing lets you keep almost all of your returns working for you. And finally, Exhibit D, the impossibility of market timing. Active investors often try to time the market, getting out before a crash and getting back in before the recovery. Sounds smart, right? But it's statistically impossible to do consistently. Missing just a few of the market's best days can completely wreck your long-term returns. Studies have shown that if you miss just the 10 best days in the stock market over the last 20 years, your returns would be cut in half. Passive investing removes this risk entirely. You stay invested through the ups and downs, ensuring you capture all of the market's gains. So, if the evidence is so clear, why does anyone still try to invest actively? It comes down to psychology. We're wired to believe we're smarter than average. We see stories in the news about people getting rich quick on one hot stock, and we think, I can do that. That's called availability bias. The financial media constantly promotes the idea of beating the market because it generates clicks and views. Buy the S&P 500 and hold it is boring news. And active fund managers spend billions on marketing to convince you they have a secret edge. But the data doesn't lie. Trying to beat the market is like trying to beat the casino. A few people might get lucky in the short term, but over the long run, the house always wins. And in investing, the house is the overall market. The verdict is simple. For the vast majority of investors, the smartest, cheapest, most reliable, and least stressful path to building wealth is passive investing through low-cost index funds. Buy the Haystack. Own the entire market. Let the power of diversification, low fees, and long-term compounding do the heavy lifting for you. Stick with your simple 3 ETF portfolio or an S&P 500 index fund. Automate your investments and ignore the noise. That's how you beat 90% of the experts, by simply refusing to play their losing game. If this video convinced you that boring is beautiful when it comes to investing, hit that like button. And subscribe if you haven't already, because we're building a community of smart passive investors here. Now, I'm curious, are you currently an active investor, a passive investor, or somewhere in between? Let me know your approach in the comments below. Thanks for watching, and I'll see you in the next one.